Listen carefully because what I'm about to show you is something Wall Street doesn't want you to see. Right now, as you're watching this video, silver just broke through $77 per ounce for the first time in human history. This isn't just another price spike. This is the clearest warning signal we've ever seen that the US dollar is entering a terminal phase of collapse, and the Federal Reserve is completely powerless to stop it. I know that sounds dramatic, but by the end of this video, you're going to see the data that proves it beyond any shadow of doubt, and more importantly, you're going to understand why this silver chart is the single most important financial indicator you need to be watching right now in 2026. Before we dive deep into the charts and the data, let me ask you something. When was the last time you saw a commodity double in price in a single year and nobody in the mainstream media seemed to care? That's exactly what happened to silver in 2025. It entered the year at roughly $30 per ounce. By late December, it had rocketed to nearly $70 per ounce. That's more than doubling in value in just 12 months. And yet, crickets from CNBC, silence from Bloomberg, nothing but dismissive shrugs from the so-called financial experts. Why? Because silver is telling a story they don't want you to hear. It's revealing a truth that threatens the entire foundation of our monetary system. And once you understand this truth, you'll never look at your dollars the same way again. So if you're ready to see the evidence that could change how you protect your wealth, then make sure you hit that like button right now. Subscribe to this channel and turn on notifications, because the information you're about to learn could be the difference between financial survival and financial devastation in the months and years ahead. Let's get into it. The silver explosion. Numbers don't lie. Let me start with the numbers that are absolutely staggering. On December 26, 2025, silver crossed $77.12 per ounce, hitting an all-time high of $77.11. This marked a 167% surge from the beginning of the year. Think about that for a moment. While your savings account paid you maybe 1 or 2% interest, silver investors saw gains of over 160%. But here's where it gets even more interesting. This wasn't just a gradual climb. Silver experienced explosive moves throughout the year. In mid-December alone, following a Federal Reserve interest rate cut, silver broke through $64 per ounce. Just weeks later, it was pushing past $77. That kind of acceleration isn't normal. That's the kind of price action you see when markets are screaming that something is fundamentally broken in the financial system, and the data confirms this. According to market analysis, silver jumped 7% in a single trading session on December 27, 2025. Gold was hitting records too, climbing 1.1% to $4,529.8 per ounce. But silver was outperforming even gold, which tells you that something bigger than just monetary policy is driving this move. Now you might be thinking, okay, prices went up, so what? Prices go up and down all the time. But here's what makes this different. This isn't speculation. This isn't a meme stock rally driven by Reddit traders. This is a structural supply and demand crisis that has been building for years, and it's finally reaching a breaking point. The Federal Reserve's dirty secret. Let's talk about what the Federal Reserve is really doing, because this is where the dollar collapse story begins. On December 10, 2025, the Fed cut interest rates by a quarter point, bringing the federal funds rate down to a range of 3.5% to 3.75%. This was their third consecutive rate cut, and while Fed Chair Jerome Powell stood at the podium and insisted these were just normal policy adjustments, the market saw right through it. Here's what Powell doesn't want to admit. The Fed ended its quantitative tightening program in December 2025. For those who don't follow Fed policy closely, quantitative tightening means the Fed was supposed to be shrinking its balance sheet by letting bonds mature without replacing them. They were supposed to be removing money from the system, but they stopped. Why? Because they realized they had pushed the financial system to the breaking point. Instead of continuing to drain liquidity, the Fed announced something called reserve management purchases. Starting December 12, 2025, the Fed began buying $40 billion per month in short-term treasury bills. Now, they won't call it quantitative easing. They insist it's just a technical operation to manage bank reserves. But let's be clear about what this really is. When the Fed buys treasury securities, it creates new money out of thin air to pay for them. That's money printing. That's inflation. And that's exactly the kind of policy that destroys the value of the dollar. Think about this timeline. The Fed's balance sheet peaked at $8.9 trillion in June 2022. After 3 years of supposedly reducing it through quantitative tightening, it still sits at $6.5 trillion as of December 2025. That's still $2.4 trillion larger than it was in December 2019. That represents an 8% annualized growth rate in the Fed's balance sheet, compared to roughly 4% annualized inflation over the same period. And now, with these new reserve management purchases, the Fed's balance sheet is expanding again. Many analysts have interpreted this program as stealth quantitative easing. Why? Because it effectively expands the central bank's balance sheet, injecting liquidity into the system. And when you inject liquidity while inflation is still running above the Fed's 2% target at 3%, you're playing with fire. The dollar's historic collapse. Now let's connect this to what's happening with the US dollar itself, because this is where the picture gets truly alarming. The US dollar ended the first half of 2025 with its biggest loss since 1973. The dollar index, which measures the greenback against a basket of major currencies, fell about 11% from January through the end of June. That decline marked the end of a structural bull cycle for the dollar that started in 2010 and ended in 2024 with an accumulated gain of about 40%. But the selling didn't stop there. According to Morgan Stanley research, the dollar could lose another 10% by the end of 2026. Through September 2025, the dollar had depreciated 13.5% against the euro, 13.9% against the Swiss franc, 6.4% against the yen, and 5.6% against a basket of major emerging market currencies. These aren't small moves. These are the kinds of currency swings that can destroy wealth if you're holding too many dollar-denominated assets. And here's what's driving it. Morgan Stanley economists estimate that U.S. growth will slow to 1.5% in 2026 and 1% in 2027, after growing 2.8% in 2024. Meanwhile, the Federal Reserve is likely to continue reducing interest rates. Their projections show rates could drop from the current range of 5.25% to 5.5% down to as low as 2.5% by the end of 2026. Why does this matter? Because interest rate differentials are a fundamental driver of currency strength. When U.S. interest rates fall to match the levels of other countries, the dollar loses its yield advantage. Foreign investors have less incentive to hold dollars. And when those investors start selling their dollar holdings, it creates a downward spiral. The dollar falls, which makes imports more expensive, which drives inflation higher, which forces the Fed to keep rates low to avoid crashing the economy, which makes the dollar fall even more. This is the kind of dynamic that has destroyed currencies throughout history. And it's exactly what we're seeing play out right now with the US dollar. NPR reported that the dollar fell over 9% in 2025, its worst annual performance since 2017. The Financial Times noted that the dollar's weakness in 2025 likely signals a turning point in its long cycle of strength, though not necessarily the end of its global dominance. But here's the thing. It doesn't have to be the complete end of dollar dominance for you to lose massive amounts of purchasing power. If the dollar loses another 20 or 30% of its value over the next few years, that's like watching a third of your life savings vanish into thin air. Your dollars will still be accepted. They just won't buy you nearly as much as they do today. The silver supply crisis. Now let's get to the heart of why silver is the perfect indicator of this dollar crisis. Because unlike the dollar, which can be printed infinitely, silver is a physical commodity with very real supply constraints. And those constraints are creating a pressure cooker that's about to explode. The silver market has been in a structural deficit for 5 consecutive years. That means demand has exceeded supply every single year since 2021. In 2024, silver demand reached 1.17 billion ounces, while mine supply could only produce 835 million ounces. That's a deficit of over 500 million ounces in a single year. The Silver Institute forecasts another deficit of 149 million ounces in 2025. When you add it all up, the cumulative deficit from 2021 through 2025 is nearly 820 million ounces. That's almost an entire year's worth of global production that has simply vanished from available inventories. And where did it go? Into solar panels, into electric vehicles, into electronics and semiconductors, into industrial applications that cannot function without silver's unique properties. Here's why this matters. Silver mine production peaked in 2016 at roughly 900 million ounces. By 2025, it had fallen to an estimated 835 million ounces. Production is going down, not up. And it's not because mining companies don't want to produce more, it's because they can't. Ore grades have declined at many mature operations. Mines have been closed across major producing countries including Mexico, India, Russia, Bolivia, Kazakhstan, and Peru. Even more importantly, roughly 71% of mined silver comes as a byproduct from mining other metals like lead, zinc, copper, and gold. That means silver production is driven by the economics of those base metals, not by silver prices alone. So even if silver prices double or triple, miners can't just flip a switch and produce more silver. They're constrained by the demand for copper, zinc, and lead. And here's the kicker. New mining projects take 8 to 12 years to develop from discovery to production. So even if companies started major new silver projects today, we wouldn't see that supply hit the market until the mid-2030s. Meanwhile, demand is exploding right now. The unstoppable industrial demand. Let's talk about where this demand is coming from, because this is the part that makes silver's rise inevitable rather than speculative. Silver's superior electrical conductivity and thermal properties make it absolutely essential to the technologies that are reshaping our world. And unlike many commodities, silver has virtually no substitutes for its critical applications. Start with solar panels. Silver is used in photovoltaic cells because of its unmatched ability to conduct electricity and reflect light. Every solar panel requires approximately 20 grams of silver for its conductive efficiency. And the solar industry is booming. According to the International Energy Agency, solar photovoltaic capacity is expected to expand by 3,200 to 4,400 gigawatts by 2030. In their latest renewables market report, the IEA projects that new solar capacity added between now and 2030 will account for more than 80% of growth in renewable power globally. BMO Capital Markets forecasts that silver demand in the solar sector will reach 261 million ounces in 2025, marking a 5.5% increase from the previous year. And here's the critical point. The latest generation of solar cells, including tunnel oxide passivated contact cells and silicon heterojunction cells, actually require 50% more silver than previous technology. So even as manufacturers try to reduce costs, newer and more efficient panels are driving silver consumption higher, not lower. Then there's electric vehicles. Every EV uses between 25 and 50 grams of silver in battery management systems, power electronics, charging infrastructure, and electrical contacts. Battery electric vehicles consume on average 67 to 79% more silver than internal combustion engine vehicles. The Silver Institute estimates that silver demand from the automotive industry will increase at a 3.4% compound annual growth rate between 2025 and 2031. And by 2027, demand from EVs is expected to overtake demand from traditional internal combustion engines. But it gets even more dramatic. If the industry shifts to solid-state silver batteries, as some companies are developing, each electric vehicle might require a kilogram or more of silver. That's 40 times more than current EVs use. Imagine what that would do to silver demand if even a fraction of global auto production switched to this technology. And then there's artificial intelligence and data centers. Silver's lowest electrical resistance among all metals makes it crucial for semiconductors, switches, transformers, relays, and capacitors. Data center power capacity has increased by approximately 53 times from 0.93 gigawatts in 2000 to nearly 50 gigawatts in 2025. That's a 5,252% increase in IT power demand, and every bit of that requires more computing hardware, which means more demand for silver. By 2026, data center demand is expected to double to over 700 terawatt-hours. By 2030, it could quadruple to over 1,400 terawatt-hours. The Silver Institute's report titled Silver, the Next Generation Metal, makes it clear that heavy demand through 2030 is coming from the clean tech sector, particularly solar and electric vehicles, as well as emerging technologies like AI and data centers. The breaking point is here. So let's put this all together and see the complete picture. You have a Federal Reserve that's expanding its balance sheet again through stealth quantitative easing, pumping billions of dollars into the financial system every month. You have a US dollar that's in the middle of its worst decline in decades, falling against every major currency. You have interest rates that are being cut despite inflation still running above target. And you have a global shift away from dollar reserves, with the IMF reporting the dollar's share of disclosed global reserves dropped to 56.92% in the third quarter of 2025. On the other side, you have silver experiencing the longest supply deficit in modern history. You have industrial demand that's not just growing but accelerating as the world transitions to clean energy and advanced technologies. You have inventories that are being drained from every major trading hub. In Shanghai, exchange stocks fell to their lowest levels since 2015. London's vaults, which are critical for ETFs and industrial users, saw massive drawdowns as metal flowed to India and Asia. And then there's China's bombshell announcement. Starting January 1st, 2026, China implemented new export restrictions on refined silver. Under the new policy, only large state-approved companies with annual production capacity of at least 80 tons of silver can export, and only after obtaining special government licenses. This effectively blocks hundreds of smaller and mid-sized exporters who have long served as key suppliers to global industrial users. Here's why that's so significant. China currently controls between 60 and 70% of the world's refined silver supply. Even a partial restriction creates an instant global supply shock. This mirrors China's earlier strategy with rare earth metals, where export controls were used to secure domestic industrial advantage and global pricing power. It's economic warfare, and silver is the weapon. The result? Lease rates for silver, which measure the cost to borrow physical metal, spiked above 5% multiple times in 2025. At one point in October, the overnight borrowing rate hit 200% on an annualized basis. That's not a typo, 200%. When borrowing costs reach that level, it means the market is screaming that there's not enough physical metal available. Physical silver inventories are disappearing. London's vaults held 31,023 metric tons of silver in June 2022. By March 2025, volumes had fallen by around one-third to 22,126 metric tons, the lowest point in years. According to market participants, there was basically no available metal left in London at certain points. Traders had to transport silver by plane rather than cargo ships just to meet delivery demand. That's how tight the physical market has become. The charts that prove it now. Let's look at the technical picture, because the charts are screaming that something historic is happening. Silver broke out of a multi-decade consolidation pattern in 2025. This wasn't just any breakout, it was a cup and handle pattern that had been forming for over 40 years. The $31 level had served as a pivotal barrier, with no yearly closes above it in the past 4 decades. Every previous attempt to break above $31 resulted in a spike followed by a sharp drop. But 2025 was different. Silver didn't just touch $31 and fall back. It broke through, consolidated, and then accelerated higher. By the third quarter of 2025, silver closed at $46.64, right at the edge of what technical analysts call the breakout zone. This signaled the beginning of a potential surge that could extend well into 2026 and beyond. Analysts who study long-term chart patterns have noted that the breakout from this cup and handle formation is projected to yield gains of over 700%, similar to the 747% rally from the 1993 low to the $31 peak. If you measure that move from the $30 breakout level, it points to a potential target between $250 and $300 per ounce. Now, I want to be clear, I'm not saying silver is definitely going to $250 or $300. What I'm saying is that the technical structure suggests this is the beginning of a major long-term bull market, not just a short-term spike. And when you combine that technical breakout with the fundamental supply-demand crisis we just discussed, you start to see why so many analysts are bullish on silver for the next several years. Metal Focus, a leading precious metals research firm, forecasts prices could breach $60 by late 2026. 57% of retail investors expect silver to trade above $100 per ounce in 2026. Some analysts are calling for silver to reach $133 to $143 per ounce by 2027 to 2030. And the most aggressive forecasts see silver exceeding $200 to $300 per ounce within the next 5 to 10 years. Are those targets guaranteed? Of course not. Markets are unpredictable, and anything can happen in the short term. But here's what we know for certain. The structural supply deficit is real, the industrial demand is real, the dollar's decline is real, and the Federal Reserve's money printing is real. Those aren't predictions. Those are facts happening right now. What the mainstream media won't tell you. Here's something you won't hear on CNBC or Bloomberg. The silver rally of 2025 wasn't driven by speculators or hedge funds making leveraged bets. It was driven by physical demand from industries that absolutely need silver to function. It was driven by investors in India buying record amounts during the traditional buying season. It was driven by Chinese manufacturers scrambling to secure supply before export restrictions took effect. It was driven by solar panel companies, EV manufacturers, and electronics producers who can't build their products without silver. When industrial users are competing with investment demand for a limited supply of physical metal, prices can only go in one direction: up. And when governments are printing currency while the supply of a critical commodity is shrinking, the math is simple. The commodity becomes worth more in currency terms, and the currency becomes worth less in commodity terms. This is exactly what we saw throughout history whenever governments debased their currencies. In Weimar Germany, in Zimbabwe, in Venezuela, in Argentina, people who held physical assets maintained their purchasing power, while people who held currency watched their savings evaporate. The United States isn't Zimbabwe or Venezuela yet, but the dynamics are the same. Print too much money and eventually the currency loses value. It's not a political statement, it's basic economics. And here's the part that really concerns me. The Federal Reserve's own projections show they plan to keep cutting rates through 2026. Their December 2025 summary of economic projections implies that the median policy rate will be around 3.375% by the end of 2026. That's a full percentage point lower than where rates are now. And if inflation stays at 3% while rates are cut to 3.375%, real interest rates are basically zero. Zero real return for holding dollars. Meanwhile, the U.S. government's fiscal situation continues to deteriorate. The Congressional Budget Office projects massive deficits for years to come. The CBO's long-run outlook highlights large projected deficits that will require enormous amounts of new Treasury issuance. And who's going to buy all those treasuries? The Federal Reserve, which means more money printing, which means more dollar debasement, which means more upward pressure on real assets like silver. The perfect storm. We are witnessing a perfect storm of factors that have never aligned like this before. You have monetary policy that's becoming more accommodative despite inflation being above target. You have fiscal policy that's completely out of control with no end in sight. You have a reserve currency that's losing global market share. You have geopolitical tensions driving demand for safe haven assets. And you have a critical industrial commodity that's in the worst supply deficit of the modern era. The solar industry needs silver. The EV industry needs silver. The electronics industry needs silver. The AI and data center boom needs silver. These industries aren't going to stop growing just because silver gets expensive. They're going to pay whatever it costs to secure supply because without silver, they can't produce their products. This is what economists call inelastic demand. The quantity demanded doesn't decrease much even when prices rise dramatically. Think about what happened in the semiconductor shortage of 2021 and 2022. Car manufacturers were willing to pay almost any price for chips because without chips they couldn't build cars. The same dynamic is now playing out with silver. Industrial users are willing to pay rising prices because the alternative is shutting down production lines. And when you have inelastic demand meeting constrained supply, you get explosive price moves. This is why silver jumped 7% in a single day on December 27th. This is why lease rates spiked to 200%. This is why inventories are being drained from London and Shanghai. The market is telling us that at current prices, there simply isn't enough silver to meet all the competing demands. And here's the kicker. Unlike previous silver rallies that were driven by investment speculation, this rally is being driven by industrial consumption that's not going to reverse. Solar panels installed today will use silver for the next 25 years. EVs manufactured this year will contain silver for the life of the vehicle. Data centers being built now will have silver in their infrastructure for decades. This isn't speculative demand that can disappear overnight. This is structural demand that's locked in for years. Thank you for watching part 1 of this critical analysis. In part 2, we're going to dive deep into exactly what this means for your portfolio, the specific strategies you can use to protect yourself, and the timeline for when these trends could accelerate even further. We'll look at the historical precedents, the specific price targets analysts are forecasting, and most importantly, the mistakes you absolutely must avoid. If you found this information valuable, please hit that like button right now. Subscribe to the channel and turn on notifications so you don't miss part 2. Share this video with anyone who needs to understand what's really happening with the dollar and silver.